Hello guys, and welcome to my channel. Today I will be going to discuss with you a very beautiful concept of investing money. So let's just look into the question. In the question we have, and this question is completely based on real life scenario. This is the purpose of this video is not to make any educational content. My main objective of creating this video is only to show how this rate of interest or the different savings alternative would come or would gives us return in what actual form. Let me just start this video. So we have 5 lakh rupees initially. So in these 5 lakh rupees, in this question we have categorized the different investment alternative into 3 part. In part 1 we taken the savings schemes. In part 2 we have considered the fixed deposit schemes, and in the last and final form I have also taken what in the stock market scenario, that is what about if I invest this money into the stock market. So now just quickly go through the question and check the what is given in the question. So now in the question, in savings senior citizen savings scheme, there is a savings account, and this question is completely based on HDFC current year data. So at current, in the recent days, the savings account interest rates in HDFC Bank is near around 2.75%. In senior citizen savings schemes, the rate of interest is 8.2%. In fixed deposit, if it is a regular or normal fixed deposits, then the rate of interest is 6.60%. If it is a senior citizen fixed deposits, then the rate of interest is 7.1%. Now I have taken an investment option where the total return after the 5th year is near around 30%. It means if I invest money in right now rupees 100, at the end of the 5th year I will be getting 130. That is, my return is 30 upon 100, which is nothing but 30%. Okay, so let me just I have discussed the entire question. Let me go through the solution one by one. So in the first case, we have considered under the savings schemes the normal savings account where the rate of interest is 2.75%. Now I have said that this is a HDFC current year data related question, and this rate of interest is available to everyone, and this is a savings account rate of interest. So my rate of interest is 2.75%, and I will be going to invest the money for the next 5 years. So we know in the compound how to calculate the return in compounding by using the compounding formula. We have learned the formula, which is P multiply with 1 plus I to the power of n, where P is the initial investment, 1 plus I means the rate of interest in absolute format, that is rate of interest divided by 100 divided by n, power of n. So if I invest rupees 5 lakh, this is my P, my initial investment, where 1 is as per the given formula, and the effective rate of interest is 2.75 divided by 100, that is 0.0275, and my avenue or my investment time period is 5 years. So that is if I solve this form or this equation, then my answers comes to 5,72,100. Now this 5,72,100 is the maturity amount, and my initial investment is 5 lakh. So by investing 5 lakh rupees at 2.75% per annum, at the end of the 5th year I will be getting 72,100. So this is my 5th year return. So now if I want to get the rate of return, total rate of return in percentile form at the end of the 5th year, which would be my return divided by my initial investment multiplied with 100, as simple as that. So this is the return, this is the initial investment multiplied with 100. My return is 14.42%. So in this way, if I calculate per year return, it going to come at 14,420 rupees. Now again, this is not a comparable this return is not comparable stock market, but let's just look all these format, then the entire scenario will be very much clear. Now let me move to this second scenario, where we have the senior citizen savings scheme. In the senior citizen savings scheme, the current HDFC rate of interest is 8.2%. Now similarly, as we have calculated in the earlier, our initial is 5 lakh. One is as per the formula, the absolute rate of interest is 8.2%. This is nothing but 8.2 upon 100, and our time period of investment is 5 years. So my maturity value comes to this. This is how this entire calculation moves by this question. So now I have a maturity value of this. My initial investment was 5 lakh, so I have earned a return of 2,43,750. So if I calculate my initial investment, if I calculate my rate of interest on my initial investment, that is for total 5 years, which comes at 48.75%. Now you can look. Now if I convert this into the CAGR, that is what is my annual per annum rate of interest, which is 8.2%, and this was already given in the question. Now we find this rate of interest that is up to 5 years. Now you can compare this with the stock market rate of interest. This is 30%. So the simple 8.5% rate of interest, this becomes 48.75% at the end of the 5th year. So can you imagine, now is it comparable? But this 30% rate of interest in stock market is not certain, but this is a very much certain. But stock market is completely volatile market. There is no chances of gaining return. So I have hypothetically taken this 30%, but this is not fixed in all the stocks. So let me just move to our fixed deposit option. At current, the fixed deposit rate of interest in HDFC is 6.60% per annum. And in the same way, if I calculate the maturity value, it comes to 6,87,300. Now 6,83,300 we have at the end of the 5th years. Now our initial investment is 5 lakh rupees, so I have earned 1,87,300 as a return by investing investing the 5 lakh rupees into fixed deposit. Now if I convert this into my 5-year cumulative rate of interest, which comes at 37.46%. Okay, and the CAGR or annual compounding that is given in the question is 6.60%. So again, this is also comparable with stock market 30% rate of interest. This is this is greater than stock market return, and also as this is a bank rate of interest, which is very much certain, and the risk is very low. Here is low and here is very high. Okay, that you also have to consider. Now if I move to our next question, senior citizen fixed deposit scheme, where this rate of interest is 7.1%, the maturity value comes at 7,09,500. My earning total in 5 years becomes 2,09,500, and if I convert this into my return, and which is 41.90%, again this is comparable with stock market. So, and this is the return is higher than the stock market, also certain. And and finally, in the stock market, this is our return. This was our initial investment. At the 5 year, we'll be going to get 30% return. So directly by multiplying this factor, we get 6,50,000 as our return, and by calculating CAGR, it comes at 5.38%. How do we calculate? By simply applying this formula, where I will divide the maturity value with initial investment with the power of n minus 1, and this 1 act as an effective rate of interest. So can you imagine in our initial question, the stock market return looks very attractive, where this normal bank's interest rate is 2.75%, 8.2%, 6.60%, 7 points, whereas this was 30%. But the problem lies in here. This is a compound rate of interest, and this is a total rate of interest. This will not going to compound in the market. So any stock broker which is grow, they used to provide this return, but the bank used to provide this return. This is the per annum return, and this is the total return. Now if we just have seen this, which is more attractive, and again this is a very risky option. Putting your money into the fixed into the stock market is very risky. Many investors in the YouTube or in any social media, they will going to advise you to put in this they also advised us to put money into the stock market, but the stock market is highly volatile. It means the return is not certain. It could be 100% in any or it could be minus 100%. So this is the case where if I start investment by investing 5 lakh, I may get rupees 5 lakh additional, then our total return would be 10 lakh, or it could also be zero. My total investment could also become zero. So that is the case. Now I have also drawn a comparison chart of by just to recapitulate the entire discussion that we have made. That is this chart. In this chart, the concepts will become very much clear. Now this was our initial investment, which was fixed in every interval. In every alternatives, the maturity value differ depending upon the cases. We have seen that the total return is in the bank account is this. In the total 5 years, this is the total bank return, this is the bank return, this is the bank return. Now this become comparable. So my purpose of doing this video is to make you understand this 30%. You should not compare this 30% with 8.5% per annum. This is a compounding rate of it. If you convert it into this return, cumulative return format, then it becomes comparable. Then you should take decision based on whether this become more attractive or not. But again, in every kind of decision, you have to be very much careful about risk, because the stock market is highly volatile. So you should be very much careful about this factor, risk factor. So thank you. This was my first video on the type of return in the stock market related content. So please provide some feedback or any suggestion that you want to see in the next video. Thanks for watching the video.